Hello, everyone. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. Thank you for joining us on this session of LTCI First Friday. Today, we're joined with Brent DeGroot from One America, and we're going to be discussing their annuity-funded asset care. Now, annuity-funded asset care has been around for years, but this can be a very popular solution for those who want to fund a long-term care insurance policy utilizing their qualified funds. So to kick it off, Brent, let's go ahead and get started.
Well, I appreciate that very much, Brittany. Yes, and I can't believe it's already June, and year close to being half over already. But glad to be on and sharing this first Friday as well. So thank you very much for that. I wanted to play. We got a new little intro. Thought it was kind of cool. So anyway, wanted to start there. All right, so let's dive into the qualified funds asset-based long-term care opportunity. First and foremost, I want to start with just a little bit about One America. Obviously, we're an asset-based leader, one of the first to market with these types of solutions. As a matter of fact, our first iteration of asset care, which is our life-based chassis, and really one of the solutions we're going to be talking about today, or the solution that we're going to be talking about today, was released in 1988. So we've had 35 years plus now of designing plans, administering plans, filing them, paying claims. And quite honestly, if you look at what the life cycle is typically from when somebody purchases a long-term care protection plan of some form, it takes about 30 years to go through a cycle before you start to see those claims and that sort of thing. So one thing that you can be very confident about here at One America is that we've had now at least 4 or 5 years of cycles going through this. So we are really understanding, the pricing and the parameters that are available, that sort of thing. So all that hopefully speaks volumes when you are representing One America to your clients. I'll also talk on our financial strength. We can trace our roots for a insurance company all the way back to 1877. So long time in the insurance business, 35 plus years in the long-term care business, but current ratings, A+ rated from AM Best. Our current Comdex is 95. So all that just speaks to the financial strength of who One America is. And we're a mutual company, which is typically where you're going to find any long-term care solutions for the most part. Most of those companies that are actually offering those are mutual companies. And I think that knowing that we're reporting to those policyholders that buy our policies and not to a stockholder, that really helps us reinvest into the portfolio, into those offerings that we make as One America, and quite honestly across the industry that are offering long-term care. Very important to look for a mutual company there. All right, before I get into kind of the annuity funded whole life or annuity funded asset care, as Brittany said, I like to talk about the concept because I like to break it down in its simplest form. And the reason for that is if we can understand the simple concept, it makes it a lot easier for us to relay that to the clients, customers that we're talking to. And it's a very simple concept when you break it down to its simplest terms. One of the things that we do at One America is we have a plethora of options to get to a tailor-made or a specific design for any client need out there. But I like to break it down to its simplest terms because if the client once understands the simple concept, now they can really understand the whole solution that you're providing to them. So first and foremost, it starts with a base policy, and that's the client's asset. So no matter what, however we're funding this, they're going to be a base policy that's involved, and that's their asset, the client's asset. That's what they will invade first, either the death benefit of the life insurance policy, which we're going to be talking about today, or we also have an annuity chassis, and it would be the cash value of that they would invade for any long-term care services first. So we'll use their asset first, that base policy. Then we have the option to add a rider, which we call the continuation of benefits rider. Now, what differentiates us from our competitors is that rider is up to a lifetime rider. Otherwise, we can just double, basically the base policy. So we've got an option to do more average planning, if you will. But what really sets us apart as a carrier is that we've got that optional lifetime benefit rider. So one of the other things that's fairly unique to OneAmerica, or was very unique to OneAmerica, and still is, at least today, is that we have a joint policy structure, meaning we can put two people on the same policy. But why I think that lifetime benefit rider, especially when you're talking these joint plans, is so important, because it boils down to nobody knows who's going to need care and who may need care first in a couple situation, how long they're going to need care, how much it's going to cost. So how much will they use versus the other spouse? So that unlimited benefit when you have a joint policy is crucial. I certainly strong feelings around that. And so I just really wanted to talk about this. But again, very simple concept. Base policy plus a rider that will continue that same income stream that they were getting out of the base policy for up to as long as they either one or a single individual would need. So very simple concept, base plus rider. Now, when I'm doing this a lot live, I don't get it quite as much on these types of presentations, but when I'm doing this live, I do get questions around offering that unlimited benefit. And they say, well, how can you do that? If nobody else does that, how are you able to do that? Well, if you think to this whole concept again, a base policy, that's their asset they're going to use first. So here's kind of what it looks like on the timeline. So first day of claim, they will go to their base policy, their asset, and take those benefits out of that policy to pay any long-term care expenditures. So that creates the income stream for those expenditures. What's great about these policies, obviously, is if they don't use all the benefits, then on our life chassis, it gets passed on as a tax-free death benefit directly to their beneficiaries. So great way to plan here. It's not the use or lose it. You're always going to get something for those premium dollars that you put in. But again, back to the timeline, first day of claim, they're going to go to that base policy to find that income stream. But once that base policy is exhausted, that's when that continuation of benefits rider kicks in. I think probably most of you have heard of high deductible health plans. I really look at this as a high deductible long-term care plan. So going to use your asset first, or the clients will use their assets first, but you've got that catastrophic risk covered by, in this case, OneAmerica. So we'll pick up all those really long, expensive claims through our continuation of benefits rider. So hopefully you understand that concept. Really pretty simple. And if you break it down to its simplest terms, I think that can really help the end consumer understand exactly how we're putting these plans in place. So now let's dive into really what I call our qualified scenario. Yes, it is called annuity funded asset care or annuity funded whole life. But I really liken it to just saying it's our qualified option. So lots of ways that you can fund asset care. So you can do it on a single premium basis where asset care plans, or asset-based long-term care protection was founded, all founded on single premiums. But now we have lots of ways that we can do this. We've actually added recurring premiums. a 5-pay, a 10-pay, a 20-pay, a pay to age 95, which is an annual premium. We can do single pays on base, annual pays on rider. Lots of ways that we can put these together. But one of the unique features here at One America is the fact that we can use qualified funds. So I wanted to point out a couple things here. So typically we're going to find those funded through a personal IRA, a 401k, a 403b, whatever qualified source that your clients may happen to have. Now, I will point out our issue ages on the qualified scenario. Because we're talking qualified dollars here, we didn't want anybody to incur a penalty, that 10% penalty for accessing that money pre 59 and a half. So that's where we limit the parameters here of 59 and a half up to age 80. The regular asset care realm, we've got the widest breadth of ages really to plan for is from 35 all the way up to age 80. But here, again, because we're talking qualified funds, the biggest thing that really to know, if you will, is 59 and a half up to age 80. We don't want anybody to incur those penalties. All right, so let's go through some key points, if you will, on before I dive into a little bit deeper and show you exactly how this works. Really wanted to hit some key points up front that you should know up front. So joint policies. Now, we see a lot of joint policies here at One America because we were the only ones that had that for the longest period of time. So joint policies is still one of those that we see a lot of. About 60% of our business is on that joint basis. But again, the other 40% obviously then is single. So we can do single or joint. But on joint policies, what's really interesting here is that we can take one spouse's qualified source or qualified dollars. So call it an old 401k that one of the spouses has that as they left an old employer, it's just kind of sitting out there, not really doing much. Maybe they've got another 401k, or maybe now they're retired, whatever the case may be. But we can use just one spouse's qualified source to put a plan in place for both of them. Now, it's interesting because I was doing a presentation on this earlier and somebody asked the question, so I'm going to try and hit it up front. So what if both spouses want to use their qualified dollars? Well, here's what we can do in that. So with this particular solution that I'm going to talk about today, it's only using one person's qualified dollars. But we can do a situation where we actually have a plan for both spouses with both using qualified scenario. Basically, we just put two policies in place where they both have access to the other. So you can use both spouses' qualified dollars if you want. Lots of times what we're seeing here is just using one of the spouses to create this plan for both. Now, what's interesting around this as well is you'll see that red note here is that even if the one spouse that we are putting in on a joint policy happens to be uninsurable, we can still use their qualified funds to put that plan in place for the spouse who is insurable. So a good thing to know there. So next key point that I really want to talk about is, when we're using qualified funds, it's a direct trustee to trustee transfer. So direct rollover, no taxation there. So whatever qualified source they have, we put it into a qualified annuity here at One America. And I'll show you exactly how the inner workings work in just a few slides here. But essentially what we're doing is then taking that amount of money, whatever they give us, and we're going to give it a 25% bonus right off the top. So great way to plan here. Who doesn't like a bonus? So again, whatever amount of money they give, 25% bonus gets added to that once it reaches the qualified annuity here at One America. Then what we're going to do is fund a non-qualified base and rider solution, like I was talking about on the concept. But we're doing that over a 10-pay basis. So we're actually spreading out the tax risk over 10 years. Why do I say that there's a tax risk? Well, you've got a qualified source funding a non-qualified solution. So the distributions over those 10 years will be taxable. The IRS is going to get their money some way, somehow, and voila, that's how we do it. But at least this way, we're not taking a one-time tax hit. We're spreading that tax risk, if you will, over that 10-year period. Now, all claims out of this particular solution are all going to be tax-free, just like any long-term care plan should be. All LTC claim payments are tax-free. Just because there's, a taxation from that distribution, it doesn't change the fact of the tax-free benefit from those claims. I will add this though as well. In that distribution that's going from a qualified to a non-qualified source, basically what happens is that distribution can be counted towards their RMD calculation. And the reason I bring this up is there are some clients out there who do not need their RMD for income. They're just being forced to take that. I mention this as well because we can plan all the way up to age 80 on these particular solutions. So what we are finding as another kind of opportunity maybe to work with your clients is those that are maybe in that situation don't necessarily need that RMD for income purposes. Obviously, the Secure Act just changed the minimum age to start taking those required minimum distributions now to 73, and actually it'll be, I think, 75 next year. So, but what I really wanted to point out is because of the way we put this very simple one and done solution together, the inner workings are paying over 10 years. Those distributions can count towards that RMD calculation. So just wanted to at least throw that out to you. All right, so those are the key points I wanted to make. Now let's kind of look at, how it works in and of itself. So I like this hourglass because I think that kind of shows exactly what's happening with this. So the top half of the hourglass is going to be the qualified annuity at OneAmerica. The bottom half of this hourglass will be the solution that we're putting in place for our clients, the non-qualified base and rider solution. So here we've got a joint policy, male, female, both age 60, and I'm going to call it her 401k. She has maybe an old 401k or current 401k, it doesn't really matter, but we're using $200,000 to fund this particular solution. So we do a direct trustee to trustee transfer, comes into OneAmerica, goes into the top part, again, of this hourglass. But right off the bat, we're going to give it that 25% bonus. We just increased that back in December of last year, along with a rate decrease around this solution as well. So it's kind of a double bonus there, a higher bonus plus a rate decrease on this type of solution. So that all happened back in December. But now that $200,000 that they gave us now is a $250,000 amount of premium source that we can use to fund that 10-pay base and rider solution, right? So it's going to be funneled down through from the top down to the bottom to pay this non-qualified solution of a base and rider. So remember, we're going to leverage that amount that they gave us up. So initially they gave us $200,000. Look what we do as far as leveraging that death benefit. It now leverages up to $267,000, $236,000. But that's also going to pay for that unlimited COB rider. Whereas since this is a joint policy, I think it's vitally important that they have that because again, nobody knows how much, how long, or how much care they are going to need. So I think it's vital that if we're going to put a joint plan together, you always have that unlimited benefit amount. Now, so to do this, like I said, we're funding this life insurance policy or this LTC solution, really, for that matter, on a 10-pay basis. So we break this $250,000 down into 10 equal parts. So 25,000 in this particular example is what is going to pay for the base policy, the base life insurance policy, and the unlimited COB rider. Now, here's where the IRS comes in, because that distribution coming from the qualified source, the top part of the hourglass, down to a non-qualified source, the bottom half, that portion is taxable to the clients. Again, spreading that tax risk out over 10 years, but that portion, they will receive a 1099 LTC for whatever that equal distribution is, right? So this particular scenario, it's 250,000, so it means 25,000. But again, remember, if they're RMD eligible, don't need that RMD for income purposes, this amount qualifies or counts towards their RMD calculation. So now, how does that break down to fund the base and rider solution? Well, let's take a look at that. Basically, just about 50-50. 50% going to the base policy, 50% going to that unlimited rider. What did that create for this 60-year-old couple? Over $8,000 per person per month in form of a long-term care benefit amount. I've added no inflation to this, but we do have inflation that we can add. We've got 4 choices, essentially. We've got a 3% compound and a 5% compound. Those can go for life, or a 3% and 5% compound that inflates for 20 years and then levels off. So again, because we've got so many iterations, I stuck with no inflation, but just know we can do inflation on these plans as well. All right, so now breaking it back down, or bringing it back to that kind of base and rider concept that I showed you. All the numbers are the same here, but I just wanted to show you exactly how we built the policy. Again, male, female, age 60. We did it on a 33-month basis, which is a 3% acceleration of that death benefit. So that's what equates to this $8,017 per person per month LTC monthly benefit. So that's kind of how it breaks down. But remember, they gave us 200,000. We leveraged that up in the form of a face amount of 267 or over 267. Gave it that 25% bonus, so added another 50,000 in there, and then that 25,000 distribution over the 10 pay, the life of this policy, will fund the base and rider solution. So pretty straightforward there. You know, what's interesting, the rate equivalent to another investment would be almost 50% that they would need to get on another investment to find the same sort of benefits that we're finding here in this policy. So just wanted to quickly mention that. But remember, this is a very simple one and done solution. Whatever amount that they want to transfer comes over, we do all the rest behind the scenes. Now, I wanted to give you a couple extra arrows for the quiver, if you will, when you're thinking about utilizing qualified dollars. And first and foremost is the Secure Act. I somewhat mentioned that earlier. So the original Secure Act, before 2.0 came out, said that any non-spousal inherited IRAs must be drained in 10 years. Well, that fit really well with the solution that we're talking about here. And well, I'll make that point here in just a little bit about qualified funds, why use qualified funds. But remember, Secure Act said non-spousal inherited IRAs must be drained in 10 years. However, Secure Act 2.0 came back and said it must be drained equally throughout those 10 years. So each year, that recipient must take a distribution equally over those 10-year portions. Previous Secure Act said they could take that whole distribution in the 10th year to make it qualify. So they did come up with a little change around that. But I will point out too what the Secure Act did here for any inherited IRA situation that you may run into, is that it removes the 10% penalty. So now it really brings in some of those, that distribution that comes from the older wealth coming to the younger generations, it brings in this as a viable solution because that 10% penalty does not apply if it's on an inherited IRA basis. So thought I would just really kind of quickly mention some of that. So, think about any inherited IRA, again, non-spousal inherited IRA fits very well into this solution. Now, I want to get back to a point that I didn't make earlier, and that was why use qualified funds? Well, let's think about this. Where are Americans saving today? Almost all of it is in qualified scenarios. So as a nation, we are very top heavy in qualified funds. Why not use a portion of your qualified funds to cover or create a plan that will cover the whole rest of the retirement portfolio, protect it from any spend down or high cost of any long-term care services. So a great place to look for any type of funding for these types of plans is that qualified scenario. One last thing that I'd like to really bring into this conversation, if you will, is an IRA gifting strategy. Now, the numbers here that I'm going to walk through are exactly the same because we're still using a joint policy where male and female are age 60. So nothing's going to change there, but here's what's different. An IRA gifting strategy says, gosh, I can gift to my child or children or whatever. And that way they can see, or I can see maybe the fruits of my labor rather than just waiting until I die to pass them on. So here we have an 80-year-old mom who is going to fund this plan for her 60-year-old son and her 60-year-old daughter-in-law. So again, the numbers are still the same, but the funding is coming from outside of the two individuals, right? Son and daughter-in-law become owner of the policies, but again, where it's funding from was the 80-year-old mom. Now, I will point out this. I told you the max age was age 80 for these solutions. So if we're doing an IRA gifting strategy like this, the max age that we could do it to is age 80. But she's the owner of an IRA. So that same 200,000 comes over. Again, just the only difference here is it's coming from the 80-year-old mother versus the son and daughter-in-law themselves. 200,000 comes over, we create the exact same plan. All those numbers are exactly the same as what I talked about earlier. Now, here's where the differences come in. Mom pays taxes in her tax bracket. Obviously, they're probably in the height of maybe some of their wage earning years at age 60. So mom will certainly pay lower taxes on that distribution or pay it in her lower tax bracket, which is certainly many things that I think everybody's thinking about taxes all the time. This counts towards her annual $17,000 gift. So just know that it would count towards that gifting credit, if you will. Son is the owner of the life policy. Daughter-in-law obviously has benefits as well, but really she's still the owner of the IRA. This creates, almost 100,000. I mean, I guess just slightly over 96,000 for the son and daughter in lifetime coverage that is all tax-free as far as benefits are concerned. And if you think about that, what are we putting into this solution? 200,000. So if this solution is going to pay out to each person 96,204 per year, how quickly are they recouping the dollars that they're putting into this as well? Each has to go on claim for a little over a year. One person goes on claim for a little over 2 years. I mean, this is a really good scenario to use for long-term care planning. Another thing this does is creates life insurance policies for grandchildren as beneficiaries. So in case son and daughter-in-law never need any care or only use a portion of the care that's available, that death benefit that's available, the remainder gets passed on to the grandchildren. So another way to create that legacy for the 80-year-old mother here. And then no need to wait to inherit that money, but again, get the benefits of seeing that put to use in that lifetime. So just another way of looking at using the qualified funds here. Now, what sets us apart here at One America, just to wrap up, both life and annuity-based solutions. Again, what we talked about today was really the life solution. Yes, annuity is kind of in the name because it comes into a qualified annuity here at One America, but it's really, that was our life solution. But we've got both life and annuity solutions, single or joint life, a variety of funding options, and especially what we focused on today, the qualified source, optional lifetime benefits. And especially when we're doing these joint plans, very important, I think, to put that lifetime benefit rider on there. Claims concierge, I didn't talk about this today, but I will tell you, we get a lot of good feedback. First and foremost, who the family talks to when that claim need arises, so where the rubber meets the road, is a nurse in Indianapolis. There is no language barrier there. Let me just kind of focus on it that way. But that one nurse will be the claim for the life of that claimant, the life of that policy. So one single point, so the family's not having to re-explain things and always talk to somebody different. It's a nurse that's assigned to that specific claim for the life of that claim, and they're in Indianapolis. Reasonable underwriting guidelines. Didn't have time to get into the underwriting guidelines today, but we do have very reasonable guidelines. And I'll mention it since we're talking life insurance. One of the differences between us and our competitors is that our competitors all offer on a accept or reject basis. We here at One America will actually can table rate for our life insurance policies, meaning we can go all the way up to table 8, and actually table 4 is still our preferred rates. Now, by saying that, we are in no way, shape, or form a substandard carrier, but having the ability to at least table rate will allow us to get coverage maybe for somebody who would be declined elsewhere. I've heard a couple of my accounts say this, we bring our cases to you first. And the reason why, if we're not going to get it through with you, we're not going to get it through with anybody. So maybe it's just a time saver. So I thought I would throw that out there. So that's really what sets us apart. I will say this, hopefully I've connected with you on LinkedIn. I do a fair amount of stuff on LinkedIn. It's kind of the only social media platform that I really use. But if I'm not connected with you, would you take out your phone and take a snapshot of that QR code there, or log into LinkedIn and reach out to me? I'd love to be connected with you. I also wanted to throw my contact information and my internal sales partner, Johnny Mendez, his contact information. Again, Brittany does an awesome job. She is so knowledgeable on our solutions and our competitors, I might add, and does a great job of supporting you with any type of scenarios that you may run into. But I will say, just in case you needed to reach out to somebody beyond Brittany, you have our contact information as well. So with that, Brittany, I would like to open it up for any questions that may happen to be out there.
So we do have a couple. This first one I'll easily tackle. So for those of you on the call, One America's pretty much offered anywhere except New York. Unfortunately, they have yet to get state approval in the state of New York, but we do have options in the state. So feel free to call our team. We can see what we can do for your clients out in the state of New York. Now, for some of you in the state of California, they do have annuity funded asset care, or what are we calling it out there, Brent? Is it asset care three,
Yeah,
two or three.
asset
It's one of
two
the
and three.
numerals.
Yeah, right.
So Asset Care out in California, it's a little bit older version of a product. And so Brent, can you speak on the slight variation to annuity funded Asset Care in the state of California?
Yes, thank you. Thanks for bringing that up. Thanks for the question. If whoever asked that as well. So let me tackle New York first, and then I'll get to California. So New York, never say never, but I'm as close to saying never for New York as possible. I got that straight from the CEO. So I just thought I'd throw that out there. But yes, I know that Brittany and the team there at our Jetter and Company have plenty of other options for you, and can certainly help you with that. California, yes, we call it Asset Care 2 and 3 essentially, because we're using both pieces, if you will. But what it does, it's a little bit different in its makeup. So first and foremost, it's spread out over 20 years instead of that 10 years. So we're spreading that tax risk out over 20 years for that for those distributions that would happen. There is no bonus. So no bonus in California. So I apologize about that. But again, what we're doing by spreading that tax risk out over 20 years versus 10 really makes that even more palatable, where that bonus really helps maybe in pay for portion of the taxes over the 10 years in all other states. So for the most part, those are the main differences, if you will. So I thought I would mention that in California. Hopefully, just was on a call slightly before this one. Hopefully, by the end of the year, we may finally have approval from California, and we'll bring all of the California solutions up to date with all the other states. But we are, for those of you who work in California or know California in any way, we are still talking about California. So I'll leave it at that.
I was going to say, Brent, don't get my hopes up here, because that would be amazing to get the updated product in California. All right, and then I do want to comment, since Brett did bring it up. Now, underwriting. Our own underwriter, Sean Whittington, would say the same thing. If One America's not going to accept somebody, we may look at something annuity fund, like truly annuity funded, or a short-term care insurance option. But when we're looking at standalone and these hybrid life insurance policies, yeah, if One America's not going to take them, we don't bother with Nationwide, Securian Financial, or Lincoln Financial, because you're either in or you're out. So there is a lot more flexibility in One America's underwriting. Do have to say, since we do have Sean Whittington on the team, if you have anybody that you're questioning about their health history, send that information on over. Sean and myself will take a look at it. We actually work with the carrier underwriting teams to make sure we can get consideration for your clients, and more so that we're quoting that individual accurately. So we are here to help with those, what we call underwriting pre-screens. But yes, One America tends to have just a little bit more leniency, if we'll put it that way. And
that's
so,
really
Brent,
that you have that. I will say, Brittany, at our Jetter and Company, having that underwriter on staff is a key benefit for any of these advisors, insurance professionals that are listening today.
Yes, I mean, we want to do our best not to have folks declined and wasting everyone's time, including clients, by filling out that application, going through the underwriting process, for the end result to be bad news that we all have to deliver. So please utilize our pre-screen services. So we're doing our best job in helping get your clients a solution of some type. And so with that, Brent, that wraps up. Oh, I just had one more question come in. Okay, next question that came up just now. Is there any growth happening inside the base policy besides that initial 25% bonus?
Yeah, great question. So the bonus, or the growth really that is happening, is in that bonus. So there will be no other growth that's going on in that base policy for that. We need that distribution to be equal over those 10 years. So that's why we give the bonus up front. That is really where the extra comes from, if you will. So no growth internally in that contract other than the bonus.
All right. Okay. That looks like to be it for questions. Now, if we get off this call and you think of some additional questions, again, feel free to reach out to myself and the long-term care insurance team. We're definitely very knowledgeable, not only in One America, but our other carriers as well. That's what we do day in and day out. So, Brent, I want to thank you today for taking time to present on annuity-funded asset care. Thank you, everyone else, for taking time out of your day to join us for this discussion. And again, if you have any questions, call our team at 800-228-0008 or email us at ltci@jetter.com. Everybody, have a great day. Thank you.
Thank you all.